Welcome to the debate. When a major earthquake hits, the immediate priority isn't really to look at your old maps to see where the roads used to be.
Right, yeah. Those are pretty much useless at that point.
Exactly. It's to look at the seismographs to see where the ground is actually shifting right now, in real time. Because, a river might have completely changed course, or a mountain pass might be totally blocked.
The old maps are suddenly obsolete.
They are, and you need a new live measurement to actually navigate that terrain safely.
And, the comfort we used to find in those old maps actually becomes a dangerous liability. If you insist on driving down a highway that has just been sheared in half by a fault line, you are going to crash, no matter how impeccably accurate that map was just yesterday.
Absolutely. And in the global economy right now, we are experiencing a massive seismic event with artificial intelligence. But instead of a seismograph, we have the stock market.
Right.
Today, we're looking at a staggering new map of that seismic shift. We are diving into Jonathan H. Westover's analysis of this really massive empirical study by Borey and colleagues on what they call the AI premium.
It really is a monumental data set. They analyze 380 trillion tokens of realized AI consumption.
Trillion, with a T.
Yes, trillion. And this is all from OpenRouter across more than 400 different language models. They basically did this to see exactly how the market is pricing AI exposure.
Just to put that in perspective for a second, a token is essentially a piece of a word that an AI processes. So 380 trillion tokens, that represents roughly 2% of global monthly AI consumption.
It's huge.
It is. We aren't looking at, surveys of what executives claim they are doing in boardrooms. We are looking at the hard, undeniable plumbing of what they are actually computing day in and day out.
Which makes the data incredibly robust, definitely. But the conclusions drawn from it are, highly contested.
Right, which brings us to our core disagreement today. We really need to answer a vital question. Does the massive equity market response to AI adoption represent an accurate structural map of future economic value? Or, and this is where we differ, is it a short-sighted market consensus that fundamentally misjudges long-term technical and organizational realities?
That is the big question.
So my position is this. The market's pricing of AI exposure, specifically how it rewards intensive, agentic use of frontier models, is a highly accurate, revealed preference signal of real transition risk and competitive advantage, and organizations absolutely must follow it.
And, my contrasting position is this. While the market is undeniably pricing in a massive shift, equating current investor consensus with long-term technological truth is deeply dangerous, especially when those market signals drastically diverge from actual technical capabilities.
Okay, let's just lay out the sheer magnitude of the market signal we are talking about here, because honestly, it is impossible to ignore.
Sure.
The data shows that firms in the highest AI exposure quintile, so the companies using this technology the most intensely, are outperforming the lowest quintile by 64.1 basis points per week.
Yeah, which is staggering.
Right. To strip away the finance jargon for a second, that translates to an annualized premium of approximately 33%.
It is a massive spread. You cannot argue with the math of the cross-sectional stock returns. The premium is absolutely there.
Right. And crucially, this isn't just some speculative tech bubble where a rising tide just, lifts all boats. The researchers tested this rigorously when they applied standard risk adjustments. Specifically, the Fama-French 5-factor model, the premium remained at 56.3 basis points weekly.
And for those who might not spend their days reading dense finance papers, what does that adjustment actually tell us in plain English?
Good question. Think of the Fama-French model as putting these companies into a financial wind tunnel. It strips away all the background noise. It ensures we aren't just seeing a premium because the company happens to be large, or because it's a traditional value stock, or just riding general market momentum.
It isolates the actual AI effect.
Exactly. It isolates it. The wind tunnel proves the market is intelligently differentiating between superficial adoption and true structural shifts. For instance, it is highly rewarding firms using frontier closed-source models with a massive premium, 53.4 basis points, which is significantly more than those relying on cheaper open-weight models at around 32.3. This is a rational, calculated pricing of systematic transition risk.
I hear you, but I'm sorry, I just don't buy that it's perfectly rational. Let me tell you why I don't think this represents a flawless, rational map of structural reality. We have to look at the startling divergence between this market premium and our absolute best technical assessments of AI capabilities.
You're referring to the Acemoglu data?
Yes, the rigorously peer-reviewed work by researchers like Darren Acemoglu, Pasquale Restrepo, Michael Webb. What these researchers do is they technically map out human jobs.
Right.
They break occupations down into discrete tasks and objectively measure which of those tasks large language models can actually automate based on cold, hard engineering realities. But when you take their technical AI exposure scores and compare them to the market's AI exposure scores from this Burry study, the technical reality explains less than 2% of the market implied variation.
Less than 2%.
Less than 2%. Think about that. There is a massive 98% divergence between what the technology can actually do on an engineering level and what the stock market is aggressively pricing in right now.
And this suggests the market is deeply mispricing actual automation potential. It is basically throwing capital at centralized, monopolistic frontier model usage today, while potentially penalizing the very analytical capabilities organizations will actually need to survive tomorrow.
I see why you think that. I do, but let me give you a different perspective on that 98% divergence. The technical task-based taxonomies from Acemoglu and the others, they are brilliant engineering work, no doubt, but they measure what could theoretically be automated in a vacuum.
Okay, but the stock market is measuring something entirely different, and I'd argue far more pragmatic. It's measuring transition risk and competitive displacement.
But how does transition risk diverge so wildly from actual technical capability? That doesn't make sense.
Because the market aggregates distributed information faster than internal engineering analysis can. It observes not just what a model can do on a whiteboard, but how competitive advantage shifts when a model is actually deployed in the messy real world. Look at how the market targets sophistication in the Burry's data. It specifically rewards power users and long prompt exposure. Companies running massive complex prompts see a premium of over 54 basis points, compared to just 33 basis points for short, casual prompts.
Right, but is that genuine organizational sophistication, or is that just capital concentration?
It is absolutely sophistication. Let's look at the retail chain example highlighted in Westover's analysis. This major retailer, they initially bought a few enterprise licenses and just gave broad, shallow AI access to their employees. Basically, here's a chatbot, go be productive.
Yeah, the scattergun approach.
Right, and the market gave them almost no credit for that. But then they restructured. They shifted investment toward intensive, agentic deployment. They used frontier models, fed them proprietary historical data, and built these incredibly complex analytical pipelines for real-time demand forecasting and markdown optimization.
Which is expensive.
It is. But once they integrated AI into the core physics of their business, they saw valuation multiples expand well above their sector peers. The market wasn't rewarding them for blindly throwing capital at OpenAI or Anthropic. It was rewarding them for fundamentally rewiring how they operate.
I come at it from a different way. We really have to ask whether the market is truly rewarding organizational sophistication, or if it's simply pricing in the cannibalistic nature of closed-source frontier models. The Open Router data shows heavy AI concentration in programming, technology, and science categories, right?
Yes, it does.
Now look at the software as a service sector example from the text.
The SaaS platforms that saw their premiums collapse.
Exactly. You had incumbent SaaS platforms that initially enjoyed high AI exposure. They built generative AI features, which were usually just basic wrappers around an API, and the market cheered them on.
For a while, anyway.
Right. But by late 2025, their exposure turned completely negative. And why? Because the frontier models advanced and began natively replicating their core functionality at commodity pricing.
Yes, they were swallowed up.
An AI or Google releases an update, and suddenly the SaaS company's entire product is just a free feature in a baseline model. The market isn't rewarding the SaaS company's sophistication or punishing their lack thereof. It's recognizing that the frontier model developers are sucking all the oxygen out of the room.
So you're saying,
The premium you see in that retail firm using frontier models is just the flip side of the market realizing that closed-source models are going to own the intellectual infrastructure of the entire economy.
that's an interesting point, though. I would frame it differently. The SaaS vulnerability you're describing actually proves my point about sophistication. The SaaS firms that got punished, they were treating AI as a conversational add-on, just a neat little API feature bolted onto their legacy software.
Well, they had to start somewhere.
Sure, but the market realized that is a highly vulnerable, undefendable position. The shift we are seeing, and this is a really critical mechanism in the data, is the evolution toward agentic workflows. By the end of the sample period in this study, over 50% of the consumed tokens were agentic.
Meaning the models are independently calling external tools, executing multi-step workflows, and coordinating actions across different software, rather than just acting as a conversational chatbot waiting for a human to type a question.
Exactly. It's the difference between asking an AI to, draft a polite email and asking an AI to independently audit a 10,000-line supply chain ledger, flag anomalies, and automatically query vendors for clarification without any human intervention.
It's a huge leap in autonomy.
It is. The market recognizes this transition to production-grade deployment. Take the regional bank example from the research. They started with 5,000 employees doing generic, open-ended exploration.
The broad, shallow access model again.
Right, and the market response was tepid. In fact, their valuation multiples actually compressed because they were just burning compute budget with absolutely no structural change. So what did the bank do? They restricted AI to a specialized 150-person AI operations function.
A tiny fraction of the company.
A tiny fraction, yeah. They gave this SWAT team deep frontier model access and dedicated tooling budgets to handle complex risk and fraud pipelines. This group of power users ended up generating 75% of the bank's total AI token volume from just 3% of the employees.
Wow.
And the market heavily rewarded them with a multiple re-expansion. The market is demanding deep, intensive, agentic deployment.
That's a compelling argument. But have you considered the long-term organizational cost of that strategy? What you are describing, what that regional bank did, is a systematic market punishment of the extensive margin.
By extensive margin, you mean broad-based employee adoption.
Yes, broad-based adoption and learning. The regional bank locked 97% of its workforce out of meaningful AI capability development just to satisfy a short-term market bias for immediate production-grade return on investment.
Well, they needed ROI.
In the short term, sure, the 150-person SWAT team drives up the token complexity, they automate some fraud pipelines, and the market cheers. But AI is a general-purpose technology. If an organization sacrifices broad organizational learning today, they are giving up their strategic optionality for tomorrow.
But do they really need that optionality if the SWAT team is handling the heavy infrastructure?
Absolutely, they do. How does that bank adapt in 3 years when AI tools need to be seamlessly integrated into local branch management or deeply personalized wealth management, and 97% of their staff have zero muscle memory for working alongside these models?
I see what you're saying, but
The market is forcing a myopic optimization. It demands you concentrate AI in the hands of a few engineers today at the massive cost of your entire workforce's fluency tomorrow.
I'm not convinced by that line of reasoning because it assumes the 97% of employees actually need to understand the foundational plumbing of AI to eventually use it. We don't require every bank teller to understand the database architecture of the core banking system to process a simple deposit.
That's a fair point, but AI is far more dynamic than a database.
True, but they just use the interface once it's built. The market is simply signaling that casual AI experimentation by untrained staff is a waste of capital right now. But, and this is key, this pivot actually translates to human skills in a way that proves the market is looking at fundamental long-term structural transitions. We have to look at the ONET occupational ratings analysis in this data.
The Department of Labor's database on job skills and characteristics?
Yes. And the way the stock market is pricing those specific skills completely upends the traditional automation narrative we've been fed for, a decade?
The old narrative being that routine, blue-collar, or low-level clerical work goes first, while high-level cognitive work and advanced degrees are perfectly safe.
Right. The market-implied occupation exposure map says the exact opposite is happening now. It heavily rewards interactive and social skills. If you look at occupations emphasizing communication, persuasion, instruction, and complex system installation, the market gives those companies a massive positive premium.
While actively punishing firms heavy on traditional intellect.
Exactly. The market actively penalizes firms reliant on analytical, scientific, and deductive reasoning roles. Negative 0.29 standard deviations for science. The stock market has realized that AI commoditizes analytical cognitive complexity.
Because the models are getting better at the hard math.
Yes.
A frontier model can process unstructured information, run scientific analysis, and optimize operations far faster and cheaper than a human analyst ever could. But an AI cannot easily replicate interactive complexity.
Right.
It can't sit in a room and convince a hesitant client to change their behavior. It can't physically install a complex system in an unpredictable environment, and it can't build actual human trust. The market is giving us an incredibly clear map here. Build interactive depth and do not overinvest in human analytical capacity, because that specific capacity is rapidly depreciating.
This is exactly where I see the most dangerous trap for organizations, driven entirely by blindly following this equity premium.
How is it a trap?
I agree that the market is currently pricing analytical and scientific roles negatively. The standard deviations are clear on that, but a negative market exposure for science and operations control does not mean inevitable absolute displacement. It just means the relative value is shifting in the short term. Think about the massive epistemic problem here.
What do you mean by epistemic problem?
I mean how an organization actually knows what is true. If a major healthcare system or a tech firm systematically guts its analytical workforce to over-index on persuasion and installation just because the equity markets currently favor those social metrics, they are completely hollowing out their core domain expertise.
Well, they're reallocating, not necessarily hollowing out.
If you fire your scientists and your data analysts and you only hire salespeople and project managers because you assume the AI is doing the math, you've essentially built a hospital entirely staffed by highly charismatic receptionists.
But if the AI is effectively performing the deductive reasoning and the scientific analysis, you don't need the human doing it by hand.
But who checks the math? When the AI doctor hallucinates a diagnosis, or the AI financial agent optimizes a trading pipeline based on a completely flawed assumption, there is no actual physician or quantitative analyst left in the building to catch the error.
That's why you have validation guardrails.
But you end up with an organization that is incredibly persuasive about implementing solutions that might be fundamentally structurally flawed.
But surely the prompt engineers...
The sophistication premium we talked about earlier, using those long prompts and agentic workflows, that requires deep domain understanding married to technical proficiency. If you follow the market signal off a cliff and stop hiring analytical thinkers, you lose the ability to actually guide the frontier models you are paying a premium for. They'll just persuasively sell you the wrong medicine.
Okay, I hear that.
The market is currently biased against analytical skills because it sees an AI passing standardized tests and lazily assumes the human analyst is totally obsolete. That is a massive misjudgment of long-term technical reality.
I see the risk you're pointing out with the hospital analogy, I really do, but I don't think it's a trap. I think it's a reallocation of human capital. The analysis doesn't suggest firing all scientists. It suggests that the pure, isolated analytical role is dead.
But it's punishing the analytical side.
Yes, because the boundary-spanning roles are what matter now. The technical specialist who checks the AI's math now needs to develop client-facing, teaching, and persuasion skills to actually implement their findings. The analytical worker has to layer on systems integration expertise.
Sure, hybrid skills are great, but
If you have an analyst who only wants to sit in a back room, crunch numbers in Excel, and never speak to a stakeholder, the market is correctly identifying that their specific workflow is obsolete. They need to become the person who audits the AI's complex workflow and then persuades the board to act on it.
But the market is still punishing the core analytical competency itself in the data.
Because it expects the AI to do the heavy lifting of the analysis. The 33% annualized premium and the structural shift toward agentic, frontier model consumption, that is a definitive, unignorable market consensus on how transition risk is priced. Organizations simply cannot afford to ignore this real-time map of competitive displacement.
They must build sophisticated, intensive deployment over casual, broad experimentation.
I agree. It is a vital data stream. 380 trillion tokens do not lie about where compute is flowing right now. But we must treat the stock market's reaction as a reflection of current investor expectations, which, let's be honest, are highly fallible.
They aren't perfect, no.
The market is aggregating information, yes, but it is also aggregating panic, hype, and monopolistic assumptions about closed-source models. Preserving strategic optionality, maintaining a broad learning infrastructure across your entire workforce, and actively hedging against this current market bias against analytical skills, that is essential for long-term survival. We have to balance intense specialization against organizational flexibility.
It is a profound structural shift, and as we look at the entire landscape of this research, it's clear there is still so much complexity left to unpack here. For instance, the stark divergence the data shows between developed and emerging markets.
Right, that was fascinating.
Despite massive AI enthusiasm and adoption in places like China, emerging market firms show minimal or even negative exposure premiums in the equity markets.
Exactly. Which again highlights that this premium might just be measuring geographic proximity to capital, regulatory alignment, and pure physical infrastructure, rather than pure organizational capability. It leaves us with a really critical choice about how we navigate the next 5 years.
It does. We are left to decide whether to trust the equity market's invisible hand to guide us safely through these new fault lines, or to rely on rigorous technical assessments when charting our own AI transition. The ground is still moving, and the seismograph is still writing. Thank you for joining us.